Yo guys, so basically my friend, right? Uh let's just call him Redox, alright? So basically he is the one who got me this TradingView subscription, so now I can finally backtest because that was something that I wanted to do for a long time. So shout out to Redox. You are the legend, my guy. Alright, so anyways, let's get back on track because now we have less time to waste. Alright. First of all, let me just disable this so that it makes more sense. All right, so you can see that this the weekly. All right, let's go from the weekly and then let's look for what's going on the bigger time frames, right? So we see a manipulation over here, and we see a bunch of displacement towards the downside. It seems like it's fluctuating, and this right here, this fair value gap was unmitigated, but now it's mitigated, right? So we see this these highs taken out, and we see this liquidity sweep. So what is this liquidity sweep right here? And it seems like we don't really have that many fair value gaps because everything seems to be properly like mitigated through. So even if it is testing to this level, it's probably going to be like this area sort of retracing higher. But the thing is, this has been wicked into, which means it's mitigated at this point. So I can't really use that as confirmation, right? But this is kind of wicked into, but it's still applicable, kind of, sort of. But overall, seems like we will be we're sweeping liquidity, of course, because as you guys can see. Oh my god, I can't speak. Basically right here. So basically it seems like the buy side liquidity draw. So we're sweeping liquidity, and now we're retracing a little lower. And overall, it seems like the whole bias is in fact bullish, but it seems like we're in a little bit of a pullback. But I'm expecting price to go a little bit higher, take out these highs, because it seems to be into this zone right here. Right, so but if you wanted to realistically compare fair value gaps, it will be this one, which is a good unmitigated fair value gap. So I'm expecting price at some point to drop here, but I don't think that's right now, because yeah, we're gonna be here for a while. Anyways, let's move on to what is this? Why did I get? Okay, there we go. So now let's move on to the weekly on wait, this was the week. What? Oh, okay, so it changes individually. That's kind of weird though. But anyways, right here you guys can see that this is NASDAQ and this is Dow. So obviously Dow has a correlation SMT, as many people call it, with NASDAQ. So what we're gonna do here first is, you can see this is mitigated properly. This is also mitigated properly, so we can't really use these low probability fair value gaps. But overall bias seems like we have swept this liquidity. Okay, this is manipulation, and then we have what distribution towards what here. Okay, so overall bias is in fact bullish. So let's just say weekly draw. Right? So this is the weekly draw, and now what we're gonna look for over here, because these are tapped into, and you can see that there is a bit of a fair value gap here. So let's see if it respects this fair value gap or not. So it's a weekly fair value gap. Okay, so it's heading towards this, right? So we have a bullish bias for now. Okay, and if we go to the weekly on, this is the weekly, right? Yeah, it's weekly. I'm pretty sure it's still a little confusing. Okay, let me just do this just to make sure. Okay, yeah. Okay, so yeah, so you can see that this seems to be using this fair value gap to sort of go higher. That's what I'm seeing. So overall we have a bit of a bullish bias, so it's going to take out these highs again and then go lower, right? So weekly draw, and this is SMT. So we have SMT correlated SMT, as you guys can see. So we have SMT and we have SMT right here. Okay, sorry, my headset keeps doing that. Okay, so you can see that this is SMT once again. So what I'm gonna do here is look for what sort of reaction happens here, and basically we have a manipulation, accumulation, manipulation, power of distribution. So we have these lows taken out. Once again we have manipulation, and we have what distribution. So I'm expecting price to take this high, but I'm expecting a reaction right here because it's unmitigated, right? So I'm expecting some sort of reaction. So these are all mitigated, as you guys can see, week 2, week 2. We have an order block right here. We're not going to overcomplicate things. Okay, so let me see. So you can see this is the 1 day. So on the daily frame, it seems like we're heading higher. As you guys can see, there's a good unmitigated fair value gap right here. So if price decides to tap back into this fair value gap, there's a high likelihood that it will in fact go higher, right? So this fair value gap has been wicked into, so it's mitigated at that point. So I'm expecting price to come to this daily fair value gap and then go higher from here towards the weekly draw. Okay, so that's what I'm expecting price to do. There's also this fair value gap, which is under the weekly, but you could use this. So I'm expecting price to sort of pull back after it takes these highs. It's going to pull back here, and then this is what I'm expecting price to do. It's going to go towards this. It's going to go to this, buy side liquidity draw, come back, use this as support, and go towards the weekly draw. Okay, it's simple. All right, so with that out of the way, this is the daily, and it seems like, let me look at the daily on this. I'm not going to use this too much. Probably going to just look at because we have a bullish bias, and I'm just going to look at 4 hour on Dow. So you can see that we have a bullish bias. It seems like it's a market maker buy model, as you guys can see, at least over here. Let's just say this is the 4 hour draw. Let me just type that out. I forgot to type that out. 4 hour draw. Okay. So just type out 4 hour draw, save as, and 4 hour draw. Okay, so basically it's heading upwards towards the buy side liquidity draw, as you guys can see. So you can see that this is the there's a lot of resting liquidity right below. So we have SMT towards the draw on liquidity. Okay, let me just say SMT, as you guys can see. Okay, so we have that clear. So now we have this bullish bias here as well. So there's a high likelihood that it's going to hit that. Okay, so what do we see here? So once we have this daily fair value gap, yeah, it was a daily fair value gap. It wasn't a daily fair value gap, my bad, I'm tweaking. So let's go back to daily, and yeah, it is a daily fair value gap, my bad. So it looks like one. Okay, never mind. So this is the 4 hour frame. So it seems like we are in fact retracing here. So we have an unmitigated fair value gap over here. We have an unmitigated 4 hour fair value gap over here. So there's a high probability that might either use it as an inverse fair value gap or a fair value gap. So I'm expecting it to take out these highs, this 4 hour draw. So this is the 4 hour draw, and basically it's going to take out these highs and then retrace lower, maybe sweep, and then retrace lower. I'm expecting a reaction over here as well. So depending on whether it reacts to this fair value gap or this fair value gap, which is unlikely that it would go all the way down here, but there's a likelihood either way. So whatever reaction we see over here, we decide to take it. So let's go to 15 minute. Seems like we have this is the 4 hour draw. So as you can see, let me just okay, so you guys can see that this is basically retracing towards this. So it's going to sweep liquidity, and that's going to come lower. So if it does come lower and decides to go higher, so it's basically going to be a market maker sell model. So it's going to sweep liquidity and go higher. That's what I'm expecting. So I'm expecting price to do, in other words, let me just draw this. So it's going to take, this is the draw right here, sweep liquidity. Okay, sweep liquidity, or maybe run even, I'm not too sure. But once it sweeps liquidity, either it's going to do this, right, go higher after taking this, and then go like this, and then, like, create fair value area like this. Like basically this is fair value area, right? So let me just call this can I not just call this like an FVA? All right, let's say FVA. Okay, so you just sort of tap back into the FVA, and then you retrace, create more FVAs, and then just keep breaking structure towards the upside. But here's the problem, right? So once you sweep liquidity, you come back down towards the fair value gap, and then you retrace away from it. So for example, like right here, this is the 4 hour draw. So you sweep liquidity, and then you come back towards the fair value gap, and then go higher. So that's what I'm expecting, right? So overall, we low-key can ride the wave, at least for like a 1 to 2. Well, after it sweeps liquidity, of course. Right now is not the time for that. Okay, so we have the 4 hour. It seems to be heading bullish as well, because mind you, a small change in this is a big change in this, right? So let's go back to the 15 minute. Okay, so basically this is we're extremely in premium, as you guys can see. We don't even need to like, okay, let me chart for the nerds. All right, so basically you see we're in extreme premium. Even in this specific market maker buy model, we're in extreme premium. Let me just okay, let me just do that. As you guys can see, We're in extreme premium. We're in almost 75. Okay, this is 25 is basically 75 in the other way. So we're in extreme premium, and we will in fact take out this sweep, come down, go higher, creating fair value area, retrace, keep doing that until unless we're creating fair value area towards the upside. So if we want to continue higher, which I don't really think so, because Dow will in fact come here and then we'll go lower. So it's gonna probably just reach for these and then just go lower. So let's see how it plays out, I guess. Of course, the next day we're gonna be trading is next week, Tuesday. So that's basically the 20th of August, all right? Because that's when market volatility is there. So sweep liquidity, come down, boom, hit, and go higher. It's simple. It's very simple. We just have to wait and see what the market offers to us, and just overall go with the flow, I guess. So yeah, pretty much I gotta backtest as much as possible now that I have this. Sweep liquidity, go higher from there. So let's see. So I will, according to my strategy, right? So this is a very specific strategy. I think I have to sort of double down on this. Of course, this is check for news, all right? Checking for news is basically Forex Factory, and sweeps. So we need to look for some sort of sweep, some sort of manipulation. Otherwise, I'm not gonna really take a trade because I don't want to be liquidity, right? So I want to see a sweep, right? Some sort of sweep, right? And then just continue. So for example, like right here, we had this sweep. This was the sell side liquidity. This was the sweep, and then this was the distribution. So you can see that this is the high time frame analysis, low time frame analysis. This is SMT divergence. You see this correlating assets over here. So you can see that this is SMT divergence. This is going higher, and you can see that it's pushing towards, this is the market maker buy model, as you guys can see, sell side, buy side of the curve. So let's hope for this weekly short to be hit, but it's gonna take a long time. So I'm expecting price to take these highs, come down, take this fair value gap to higher and higher and higher draws, because we have this indication over here, because it's also heading towards what, this 4-hour draw, in other words, this liquidity. So we don't really see equal highs or equal lows at the moment, so it's kind of annoying. Let's see. Yeah, we don't really see any equal highs or equal lows, but I mean, sure, you could consider these as equal highs, but it's not really equal highs. We need to see like an area of equal highs. So anyways, that's besides the point. So we're gonna retrace back to this for a fair value gap, and then retrace higher towards the weekly drop. Okay, it's very simple. So overall in the OTE, let's say like in the overall OTE, if we can in fact get in, yeah, we're already in premium even in the bigger time frame, but I think we can still try to get in. I mean, honestly, yeah, we can get in. It's not that big of a deal. Of course, it's gonna be a little riskier because we're in premium now, but you still can get in. It's not like you gotta miss your trade completely just because So yeah, it is what it is. Anyways, yeah, it's just 4 hour. Okay. So anyways, let's go back to 15-minute. You see, this is the fair value gap over here. So you tap back into it and then you go higher. Simple stuff. Cool. Great. Amazing. Okay. Amazing. So you go tap and then you come. Okay. Let me show you guys some. Okay. I don't wanna yeah, so it's just you scroll and then you tap and then you go high. Okay. Okay, whatever. As long as it works, I guess. As long as it works. So you take this, sweep liquidity, use this fair value gap, go higher. That's what I'm expecting price to do. Okay? It's pretty simple. It's pretty easy. So on the 5-minute, I don't really care about the 5-minute. I'll keep it a buck unless I miss my optimal trade. So if I miss a 15-minute trade, that's when I take the 5-minute. So simple. So forward analysis, and then exactly, see, 5 minutes, it's just a confirmation just in case I miss a trade, and I want to sort of get in on a good pullback, if that makes sense. Right? So if I miss 15-minute, I'm just gonna go for a 5-minute entry. So, and plus this is a good confirmation if it's on a price pullback or fractal concept. So anyways, there's no fair value gap, close. That's do not enter. Let me just get rid of the. Do not enter if there's no fair value gap. That's one closing one above the 5-minute fair value gap, right? Yeah, so basically that needs to be like, even in the 5-minute fair value gap scenario, there needs to be one above. Do not be tempted to enter in at random spots just because the market is moving. Just simply, exactly. And do not entry during red folder news. Entry after those, exactly. After. This is very important. Okay, after. Only trade on. These are only trade on these days: Tuesday, Wednesday, and Thursday. Simple. After red folder news. High confidence, you take 2 confidence. If there's two or more confluences, then we'd go for IRR. Okay. If there's low confidence, you take a 1 to 0.5 IRR. Okay. 1 minute is basically, yeah, exactly. 1 minute, I'm not really considering this. Hold winning trades longer. Be patient before executing a trade until proper formation happen. Exactly, I need a back test now. Okay. Journal, this is basically stick to one pair. That's basically mainly NASDAQ. So I gotta just make sure I stick to only NASDAQ, at least until I'm good at NASDAQ. You know what I mean? It's no point basically going for, because I see a lot of consolidating phases in gold especially, so it's no point really doing that. I'm just gonna keep it a buck. I'm just gonna trade NASDAQ for a while, at least, you know, because I think then the shift for S&P would be easy as well. Trading breaker blocks might be high accuracy, exactly. Never use 5 minutes for entries. It's just to confirm if the entry is great. Right, SMT, that's right. Do not sweeps, okay. Equilibrium, of course, we have a reaction there. Of a 0.5 OT basically. Near swings, basically liquidity sweeps, yeah, exactly. So near swings, and be wise about the liquidity sweeps, exactly. So this is basically near straws, in other words. Straws. Target the first equal level in a magnetic zone. Yeah, if you have equal highs, for example, that's basically like equal highs and equal lows. So it's basically like a magnetic zone. Maybe even like a rejection zone right above. Look for general swings, but swing highs, okay, that's right. High time frame, low time frame. Unmitigated, no, look for unmitigated fair value gaps, because those are the high probability ones. Anyways, look for liquidity sweeps. Yes, exactly. I look for order blocks, supply and demand, right? Look for a breaker, or better, look for a unicorn. Swing low. Fair value gap, swing low, stop loss. That depends on scenario. Also, slash swing low, stop loss. Swing low, wick, stop loss. Okay. Respecting fair value gap or not in a reversal scenario. This is in general if it's respecting the PD area or not, right? Especially high time frame PD areas where price is telling a bigger story. If it's using this as like a fair value gap, I got a backtest now. But let me go back to my. It gets very confusing to have 2 things on my screen, but yeah, I got a backtest as soon as possible. Anyways, let me see if I can. I gotta make sure. Yeah. Anyways, I'll get to backtesting. Use fair value gaps and how can we use it? Wicked fair value gaps are not gonna be used again. It's called mitigated. All right. Every week, the week starts. The way the week starts is the end. Oh, really? Is that so? Is that so? I don't think that's right. I don't think that's right. I don't think that's. No, that's bullshit. It's not the opposite. It dropped completely. See, it dropped completely. It didn't what? The opposite. What kind of bullshit is that? No. Bearish on Monday, the 29th. Okay. Let me just. What? July, okay, my bad. Fuck. Why is it doing that? Okay. Anyways, the fair value gap, lowest fair value gap area. That's right. Good for entry. High time frame, low time frame. Displacement can be used as a key level. Yeah, sorry. So we have this at OT, so equilibrium in other words. So this is a low resistance equilibrium because there's a lot of candles that sort of indicate that it's going in the direction that it's supposed to, but it's like very, very slow. But in this scenario, you see that there's like higher displacement as well. So low resistance. See the sweeps taken out from one another, and it keeps retracing towards the draws. Don't trade outside session, less volatility. That's probability. That's right. Trading only off news is basically the setting yourself up to failure. Where should we look for SMTs? I gotta watch this video again. What is this video? I've watched this video like multiple times. Let me see. Short-term lows and short-term highs between two short-term highs. Yeah, basically this is what this is basically is. Let's say on like, yeah, let's say like one of these inter-term highs are broken, it sweeps liquidity and then it just goes higher. But that's not as simple as it looks, because you need to wait for like inducement to take out the sweeps and then go higher. Anyways, Unicorn is a very time-consuming model. Exactly, Unicorn is a very time-consuming model to form, so you shouldn't wait for unicorns to form every single time. You're gonna miss like every trade, and like the probability of winning a trade is like low. So, I mean, high, but still low chances of unicorns forming and being right every single time. So, is there a market maker framework? Yeah, it's basically market maker model or market model. The quicker you get in on a swing, the less money. Yeah, that's obvious. If distant entry is fair value gap, wick low par as stop loss. If the candles are moving with high resistance displacement, right, this is high resistance liquidity. High resistance liquidity. And then we have if the candles are moving with low resistance bullish, but it's very small candles, exactly. Low resistance liquidity. It's basically a low resistance liquidity. High time frame short term high is equal to a low time frame inter term low. What? Inter term high? What's this nonsense? Short term high is that's right. So if you look at like, for example, like a specific swing, like this short term high, you can go down to like, it's a, if I highlight this area, and if I go down to the 15 minute, you can see that this is it's gonna be an internal term high right here. This is an internal term high on the low time frame, so it's a bunch of short term highs to the left and a bunch of short term highs on to the right. Where's the next short term high? It's like over here, my bad. Sorry, short term high is over here, my bad. This one, and there's another one over here. So yeah. It's always either market making models or consolidating. Ideally consolidating phase 8, that's right. If like wherever they get reaction, don't wait for it. Day swing higher and low. I haven't really considered the whole 20 day policy. It's basically like the, let me see. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So it's 20 right here, over here, to this point, which is basically a current candle. So you can see that if I go down towards this fair value gap, not fair value gap, towards this time frame, you can see that this is a downward spiral. And it's a swing, so I gotta mark the swing high and the swing low of this trend. So the swing high is all the way up here, and the swing low is all the way down here. So it's within this range, right? So I remember ICT said something about ICT 2024 mentorship. It wasn't on this ICT 2020. There was one of these websites, I fucking forgot which one it was. See, this is the, yeah, exactly. So this is the delivery algorithm thingy. So basically focus on exploiting short-term price movements. This model is designed for traders who prefer quick, small. That's right. Theater for capture. That's right. Swing trading, day trading is what we do. Scalping. No, I don't do scalping. Short-term trading model. Session trade. I mean, it's during market sessions. That's when day traders also come in. So, what is the best ICT course? Liquidity pools, market maker methods, optimal trade entry. That's right. Charter price action. OTE pattern recognition. That's right. Market maker series is okay. That's all right. Market maker is basically 2023 mentorship. This is 2016. I'm pretty sure I went through this. Yep. Fair valuation, liquidity runs. You plus price swings. That's right. But I do need to. Wait. Let me go to ICT trading. I think it was one of these websites talking about it. What is this? It's an implied fair value gap. Inverse. It's an inverse fair value gap, isn't it? Okay. What is the implied fair value gap? It's not a typical fair value gap, but basically it is a hidden fair value gap, and the algorithm uses it to reprice and balance the price delivery. It is formed when price falls / rises with a displacement move, and large-bodied candles form the wicks overlapping each other. It's formed when price falls / rises with a displacement move, and large-bodied candles form with the wicks overlapping each other. I mean, it's basically a fair value gap, right? Each other. Personally, no visual fair value gap. Okay. What? Oh, okay. So it's basically like there's no fair value gap, but you're still gonna use it. What? As we discussed earlier, implied fair value gap is not visible. Instead, you have to look for like displacement move with large candlesticks. I mean, yeah, of course, this is gonna be one big displacement move, right? Even though there's no fair value gap. If you're looking for ICT inversion fair value gap, okay. Pretty sure I went through this before. Yeah, so there's no fair value gap here, but you're still gonna use this as a. Oh, so it's a previous fair value gap which is used as a support level. I think that's what it is. Yeah. As we've discussed earlier, fair value gap is not visible, and so you have to look for displacement move with large candlesticks. That's right. Look for a large body with candlestick with bull whose body is overlapped by the wicks of the previous and next candlestick. Previous and next candlestick. So it's basically there's no gap left. That's what it's saying. You have to identify a bullish, large-bodied candlestick whose body is overlapped by the wicks and preceding and following candlestick. Using the Fibonacci, measure the consequent encroachment and the level of the upper wick of the first candle, the candlestick before the large. So basically what you're saying is, so what? But I thought an IFVG was an inverse fair value gap, so it's a implied fair value gap. Implied fair value gap. So it's basically like there's no fair value gap. It's just the wicks, but you're gonna take it from like the 50%. That's what I'm saying. Equilibrium. Doing charting on a specific fair value gap is like kind of crazy. To identify an inversion fair value gap, you should first identify a fair value gap. As fair value gaps are of two types, so the inversion fair value gap has two types as explained below. As price moves in a direction, it respects the fair value gap and continues its move. Right. But if a fair value gap is violated, acts as an inverse fair value gap and signals the shift in momentum. Okay, that's right. In a short retracement or change direction later. As fair value gaps of two types, so the inversion fair value gap has two types explained below. Bullish fair value gap, that's right. It's basically a bearish fair value gap, just violated by price closing above it. That's right. And I understand this policy. You're basically inversing. But I don't understand what this, I mean, this is even, I understand this too, but I just don't understand this. Like, why did they do some charting on the phone discount zone? That's right. That's right, yeah. But I feel like this might be like a trap, low-key. Like an inducement trap. Even though they buy it right after failed market structure shift, when the price is in the higher time frame PD area, and shifted structure in lower time frame where traders look to buy / sell in the fair value gap. So basically, you're selling if it fails to have a market structure shift, right? In the lower time frame, people buy or sell after the market structure shift. When the price is in a high time frame PD area and shifts the structure in a lower time frame, traders look to buy or sell in the fair value gap. Right, okay. Right. I'm gonna go through this again, man. My brain right now is just kind of tweaking, honestly. But obviously we entered before 0.5, that's the whole point of discount. But here's the thing, right? I just don't get, where was that? Yeah, this one. That's what I was thinking. Next you see, so you're basically saying find 3 candlesticks that are displacing, and then just don't, even if it doesn't have a fair value gap, just use 50% encroachment. Candlestick before the large bullish candle. Next, use the Fibonacci tool to measure the consequent encroachment, 50% of level of the lower wick, right? And of the third candlestick after the large bullish candle. So it's this one. So then you take this. What? Okay, so you're taking 0.5, 0.5 from each of these. Like, why the fuck are you doing that? Oh, you're trying to find like an OTE balance price range between these two. That's so confusing. That's such a confusing concept. Or just take one whole snip so it makes more sense. So basically saying do an OTE on each of these fair value gaps, right? This wick, right? Assuming this wick comes here, and this wick goes here, right? We want to put an OTE on both of these, and then get in here. That's so weird. Yeah, that's what. Oh, so you're gonna consider this area as like a fair value gap. I bet I can't draw. See? So you're gonna consider this area as a fair value gap. That's crazy. It's actually fucking wild. That's wild. I'm not even kidding. That's actually wild. Because it's like I don't know. It feels so unsettling. Because I'm so used to like fair value gaps, and this is like kind of bogus, you know. Anyways, let me just make sure we'll take note of that. All right, whatever. As long as it works, I guess. As long as it works. Let's go back. Oh, okay. Yeah, this is consequent encroachment. Once again, I'm just gonna take the bearish example as well. Let me just copy this real quick. And let me just paste this in my journal. So this is the implied fair value gap, as you guys can see. So we have the determine market trend. First of all, we need to. Yeah, obviously this is common sense. No one's just gonna like. So this is obviously you're gonna use a fair value gap as like a confirmation after we have the overall analysis. High time for PD area, we'll look for market structure shift in a lower time frame. That's right. So now what they're saying is basically, let's say for example, like okay, so let's say for example this is the 4 hour. Like you see like 2 candles sort of like let's say this is what's happening in the 4 hour, right? So you have the fair value gap, so it taps in, then goes higher. So what I'm expecting price to do in this scenario is it's sort of going to use this. So like over here you will see like market make a buy model in the lower time frame. So that's what they're saying, right? If you go to like the lower time frame and say like this is 4 hour and this is like 15 minute, if you go to 15-minute right here, you will find this as a market maker buy model on the low time frame. That's basically what they say. So in other words, you have a confirmation. So obviously you need to see for look for a market structure shift in a low time frame. So a market structure shift happens when you identify this as a market maker buy model. Obviously when you come to like, let's say 15-minute, right, of like in this type of momentum. Okay, so obviously in the 15-minute, what's going to happen is you're going to see this, and then you're going to see the, you get the point. So you see like the market structure, the market maker buy model. You see this market structure shift over here. So this market structure shift can be used to go higher, see, in a low time frame. So this market structure shift, and then you go down, tap into it, and then go higher towards whatever the draw on liquidity is. So I think, yeah, I mean, it makes sense in that sense. I'd felt large candle to have determined the KPDRA next time. Next step is to find a large bonded candle with a large body. The market is in trend. In bullish trend, we look for a strong bullish candle with most body range. Strong bullish. So if it's in a bullish, if the market is in a bullish trend, well, yeah, obviously you look for the opposite here, right? So let me just note this down. It's actually pretty cool. And vice versa. Okay, so study and proceeding. Mark using the Fibonacci tool. Okay, that's right. So they're basically saying, look for a fair value gap. I mean, look for a bunch of displacement. Put a fair value gap on either side of them. I mean, put a OTE on either side of them, right? And then, like on the wicks, right? When it's 50%, wherever both of them align, you create a fair value gap there. I mean, not where both of them align, like the 50% of the lower wick and the higher wick, you create a fair value gap. That's such a weird concept. But I mean, I won't really question it. If it works, if they say it works, it works. Because then price uses it as sort of a inverse fair value gap, even though there is clearly no fair value gap here. It's just the wicks. So you're creating fair value gaps out of these wicks, the 50% of these wicks. Those are going to be like the upper and lower bound of the fair value gap. Seems like a good concept, I see. Let me try to see if we can do that. That's such a new concept to me, honestly. Okay, so let's look for a bunch of displacement, but no fair value gap, right? So that's like a very specific use case. Like a very specific use case. Do we see, I'm so used to like seeing fair value gaps, like I don't really, wait, let me see if I can find one of those. So obviously you need to see displacement, like it needs to look like a fair value gap, but like not a fair value gap. So it's like exactly like a fair value gap, but like see, even everywhere there's a fair value gap. Okay, let's say this one. Even there's a fair value gap. See, some sort of fair value gap being left behind. So this is such a weird encounter. I need to study this properly, because it's such a weird thing to see. I haven't really came across anything that looks like this before. So that's kind of weird, but it's alright. Because there's always fair value gaps, right? So imply there's always a fair value gap. See, even here, even if it's mitigated, it's like we look for. Let's see. It's okay. Anyways, implied fair value gap. So, anyways, I gotta go through this on my free time as well, just to see what this is about. Let's see what this new lesson is about. Quasimodo. The fuck? There's a reversal chart pattern. If formed at a higher time frame support resistance level can indicate a change of the trend. It's called a Quasimodo pattern. At the end of the bearish trend at a key level. So, you know, so they're putting new names for like an inception basically. Straight bullish Quasimodo pattern. Let's just call it a QML. Identify the second to last low. Second to last low and the last low before the formation. This one, okay. For imbalances. Mark the area between these two lows is QML. Okay, so this is the QML zone. For imbalances, demand zones, FTR, and that's okay. Execute a bullish trade when the price taps this area, or wait for confirmation like a market structure shift. Of course, like basically this right here. So they're basically saying this is the zone and this is the lower zone. So you tap, you wait, execute what? Look for bounces, demand zones or FTR levels. It's okay. Execute a bullish trade when the price taps this area and we'll wait for confirmation like a market structure shift on a lower time frame. So they're basically saying you can use this as like a sort of goes higher, taps back. You can use this as like a zone. Okay. Place your stop loss before the last low, QML low, and the target high for profit. Quasimodo, okay. You tap back into this and then you retrace the lower from it. Let me take note of this. I gotta go through this one. It is a little more chill. Quasimodo, so it's basically a level of support or resistance depending on how you see it. Like depending on the context, obviously. So it's basically the previous low or the previous short-term high. Okay, in this scenario, the short-term high. Then we have the short-term high. So this short-term high, these two short-term highs, right? Oh, let's just say it's the inter-term high, short-term high. I mean, this is gonna be the inter-term high in this scenario. Short-term high, inter-term high. You basically plot two lines between, and this is gonna be a zone of resistance for in this scenario because it's bearish. So it's gonna be resistance, and then it taps back into this area, uses this, and then it goes over. Obviously in confluence with the other things. It's great. It makes a low breaking the previous low, higher low. It forms a structure known as a right. So you see, if you see a market structure shift here, you can basically take it down towards this one. Sweeps, comes back, and then goes lower. It makes sense. I mean, if you think about it, even in like a different perspective, it's just basically sweeping liquidity. It's like a confluence, basically. So it should be like an MSS somewhere here. Also demand pattern. Who the fuck came up with this like name? It's so like weird. I'm sorry if it's offensive, but it's such a weird name though. Quasimodo pattern. That's right. Exactly. So bullish to bearish or bearish to bullish. That's okay. How to trade a QML pattern. Identify the second to last high and the last high before the formation of a QML. For imbalances afterward. You have an example right here, so I'm just gonna go through this later today as well. Hold up, let me just, okay, I think I'm fine now. My brain's still slow as fuck, I don't know why. It's almost like I need sleep or some shit. QML pattern is basically based on the concept of change of character. As we know, when price changes its trend and breaks lower, higher, or higher low in a bullish trend, a bearish trend, it's called change of character. Yeah, that's right. This is correct. Sometimes it may indicate a reversal of price before the change of character happens, because every high low is not a structure high. QM pattern is significant because it helps traders identify potential trend reversals at key levels, allowing them to enter trades with high probability of success. Yeah, that's right. QM pattern. Quasimodo. Basically a higher time frame. That looks best on high time frame. Okay, so traders use the price reversals from key levels such as high time frame, supply or demand zones, support and resistance zones. It helps identify potential turning points in the market. That's right. Now that I'm done with this, I'm actually gonna move on to the next thing in my life. That's basically going towards the ICT 2024 mentorship training. There we go. Basically, which one was it? I can't remember. Was it this one? No, it wasn't this. Yeah, it was this one. Charter price action. Just the last 20 days. The range between the swing high and the swing low in the last 20 days. Okay, so you want to look for like protected lows, I guess. Let's look for 20. Just the last 20 days. So these are the last 20 days. So it's sort of like fluctuating in this range, I believe. It's not really protecting any lows. It's a very inconsistent pattern over here. Okay, this level seems to be kind of protected because it's just the market structure over here. Other than that, it's not really protected low. Making the narrative on this basis that I mentioned. Says the liquidity of the previous days low. That's right. So we have a breaker. No, we don't have a breaker on the weekend. It's not a bearish breaker. Are you serious? We have a high, a low. We need to have a high and high. What do you mean that's a breaker? It's not even. This is like a mitigation at most. There's no breaker here. Market structure shift. That's right. You sweep the liquidity, and then you come back, use this fair value gap, and then retrace over. Okay. Price action. Yeah. Previous day's high. Finding intraday scalping opportunities. Sometimes it refers it's a previous day high and low trade profile. Okay, so it's basically the last 20 days, of course, right here. Not really to hold trade longer or overnight, no swing trading. For quick setup, over wanting for long-term formations, right? Or enter into the trade, use the, okay, that's right. Buy model, 20 days of the data range, that's right. Not in the price is not in the premium zones. Equilibrium of the daily range of the previous 20 days, that's right. Buying can be considered at equilibrium of the daily range of the previous what? So you want to like buy at the equilibrium. So say ICT 2024 last 20 days, mark out swing high plus low, and then swing, then look to entry at the 0.5, should say equilibrium. So it's basically 20. Price is not in the premium zone. Of course, it's not in the premium zones if it's or below, of course. So they're basically saying, okay, now I get it. So they're saying entry. So that says the 20 days, right? 20 days range, swing high and swing low, mark it out, and basically plot an OTE between these two, right? The swing high and the swing low, right? That's how we plot OTEs, of course. So then they're saying entry when it's at a discount. I mean, it makes sense in that sense because they're using this as a level of interest, point of interest. As it's basically that's what this is about. Okay, I get it. 20 days. Okay, that's right. Mine can be considered exactly. So it's basically 20-day equilibrium or lower because the swing low is made at this point. So it's discount if you're getting in even at equilibrium, even though there's a reaction here, this is still discount. So you can still go towards this swing high because price is ultimately going to deliver there. That's what it's saying. Like to swing high, this draw. It makes sense if you think about it. Parabolic expansion runs will be above the equilibrium level of the. I gotta backtest this a bit. Hold on, let me just go back like a few days back. Say like over here, I guess. Okay, so now let's look for 20 days. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So it's right here. Bro. Right here to right here. Okay, so what is the swing high and what is the swing low? This is the swing low and this is the swing high. Okay, so they're basically saying price is going to range between these two ranges, right? But then I have a question. Whatever the swing high, okay, whatever the swing high, my question, whatever the swing high that's formed can't really be, so for example, like, let's say this swing high and swing low, right? Swing high and swing low. So like swing high over here. This is just in this specific trend. Like, oh wait, I get it. So it's basically saying you can entry as long as it's below 0.5. So you can sort of expect price to go back higher toward this range. That's what it's saying in the last 20 days. Okay. So you can expect price to go higher towards that earlier. Of course with confluences and stuff. Monday through Wednesday is ideal to buy in ideal buy days in the New York session. Thursday can be considered as the Monday to Wednesday. Thursday can be considered as long as the liquidity remains for the lower resistance. Run at 5-minute chart. Look for retracement lower against the London session for momentum in the day using the bullish OTE pattern, keying off the 62 level plus 5 pips for spread of entry. Okay. Let me look for this, the next marker. Gotta look for this. Monday through Wednesday is ideal buy days. So what? Bullish. The New York session. That's what? 6:30 p.m. in my time, but it's 9:30 a.m. Thursday can be considered as long as the liquidity runs remain low resistance. As long as the liquidity remains for the low resistance run. So let me just go paste this real quick. And let me see what else we can find. 62% level. Your kill zones, IPDA, optimal trade entry, that's fine. Sell model. This is the swing low. Shorting only when the daily has taken out a swing low. And it is not in a discount zone. Shorting can be considered equivalent of the daily range. Daily range, okay. Shorting can be considered the equilibrium of the daily range. So you take the last 20 days, swing high, swing low, equilibrium, boom, you short from there. Depending on if the price is going lower or higher. Shorting only when the daily has taken out a swing low, the last 20 days, IPDA, data range, and not in discount. Shorting only when the daily has taken out a swing low in the last 20 days, IPDA, data range, and not in a discount. Okay. Parabolic expansion runs when will be below the equilibrium of the 20-day IPDA as it targets the previous day low and liquidity pool below it. What that? Okay. Anyways, I gotta really lock in on this, try to study this, but anyways, let's get back on track. Important points. Could you follow the same protocol? This is good too. It's to be continued until the daily liquidity pool is reached and swept. I won't trying to use fight the order flow on the daily chart. Max and capitalize PD raise from that form in the New York Kill Zone. Do not force another trade if you are stopped out. Or the wait for another day to enter. If the trades stop out, it tends to suggest momentum is weakening and let's try another New York session. That's right. This is a lot of value. Yep, okay.
Welcome to the Ultimate Beginner's Guide to ICT Trading Concepts. This video is a summary of the foundational concepts found in the ICT method.
I was going to go through this once again just for, clarity.
Let's begin talking about swing points and the idea of liquidity, or buy orders. This idea leads us directly to the concept of buy side presents as a swing high or buy side liquidity. Notice that in the example of the old low, price reaches the old low without closing below it, and then it starts to go up. That's an important idea not only in ICT's method, but in the overall idea of market manipulation, meaning the triggering of liquidity in order to deceptively induce retail traders to one side of the market. Example of the range from a swing low to a swing. This notion of discount highlighted candle, creating a gap between the two. Let's make a quick value gaps. Let's now.
I watched this like 10 times before, so that's why I'm skipping through.
Low probability order blocks. Let's sure. The order block occurs at the open of the large bodied bearish candle that sweeps sell side liquidity. Price will often retrace back to the order block before moving higher. The bearish variation of an order block is formed by the large body bullish candle or series of large body bullish candles that sweep buy side liquidity and then lead to a break of an old low right after it, which in this case is called break of structure. The order block occurs at the open of the large body bullish candle that sweeps buy side liquidity. Price will often retrace back to the order block before moving lower. Notice that high probability order blocks come from simple expanding pivot formations, where a lower low is followed by a higher high in the case of a bullish order block, or when a higher high is followed by a lower low in the case of a bearish order block. We also have the low probability order blocks, meaning the movement upwards, the latest swing high, in case you and then fail CT concept. Notice that step is to mark out the high and low. Let's reach the next day. Start the foundation panel, activating the.
Alright, so I'm just gonna chill out for a bit because my head is sort of like spinning. I don't know why. Anyways, thank you guys for coming, to whoever that came. I can't wait to backtest and see how price plays out. See, you can buy back exactly. See, happens visually. So let me just take this as an example, sort of. Alright, thank you guys so much for coming by. I'm going to see you